register. Is already registered. Okay, let's start by, as usual, I gonna make a recap on the major uh, elements that we have discussed lesson yesterday. So yesterday we learned about how to form a portfolio and calculate or compute the expected return of a portfolio with the obviously the risk of the portfolio as well. All right, so that is the way. We also learned that when you form a two stock or more than stocks, the combining risk or the risk can be reduced from the portfolio, and these we called it as the diversification benefits. As long as the correlation is less than 1, we're gonna be able to diversify some of those risks away. What type of risk that's gone away? Can we diversify systematic risk? Oops, sorry, whoop. All right. You see my slide now? You see my slide now? Yes. Okay. So yesterday we learned about how we form a portfolio and how we calculate the portfolio expected returns or portfolio realized return, as well as the risk of a portfolio. Okay. When you combine the risk, the risky asset in your portfolio, some of the risk can be diversified away. Like the case we do the Northwest and West Air, you can see that 13.4 volatility can bring down to 12.1%. We also learned that the more, if the correlation between the stocks inside your portfolio is smaller, okay, or even negative, you're gonna be able to diversify even further. So therefore, the volatility of your portfolio may, become smaller. That is what we call diversification benefit. And this diversification benefit, depends on something called the correlation to see whether the return of one stock, how that move in relative to another stocks. So if you have two stock, you can see the correlation. If you can have a three stock, four stock, n stocks, you can do the same thing. Okay, so that is the way we start to learn how we compute the covariance and correlation of the pair of stocks, and then therefore we're gonna be able to get an idea on how we can diversify the the risk. What type of risk that we diversified it here, that we eliminate it from diversification? What type of risk? What type of risk is gone? It is everybody know that the volatility has two components, right? One is specific to the firm, which is we call idiosyncratic risk or firm specific risk. And this one, when we form a portfolio that yesterday we tried to prove it, that is why the volatility of the portfolio reduce, okay, because it eliminate or they eliminate the idiosyncratic risk of each stock, okay. Whereas at some point, okay, your diversification benefit cannot do it anymore. So because the diversification benefit, as you can see from this graph, okay, until you add more stock in your portfolio, and then the reduction or diversification benefits going down, and then until you cannot diversify it anymore. Okay, when it's not diversified anymore, meaning that your portfolio contain almost only the what type of risk? Total risk, systematic risk. When you cannot diversify it anymore, okay, it means that your portfolio contain only market risk or systematic risk. Okay, to have this systematic risk, okay, investor may be happy, okay, to hold systematic risk. Why? Because they get compensation to hold those systematic risk. Okay, so therefore we learn that the systematic risk, okay, cannot diversify the way, whereas idiosyncratic risk can be diversified, and therefore we're gonna be able to compute like the case that we have seen here from the real stocks in the US. Okay, we're gonna be able to calculate the variance or the volatility of the two stock portfolio, which is equal to the square root of x1 square standard deviation volatility of the stock one plus x2 square volatility multiplied by volatility of the stock 2 power 2, okay, plus 2x1 x2 correlation r1 r2 sdr1 sdr2. If you have a look in these, you can see that the last term is the term where it's gonna play on the variance or the volatility of the portfolio. The less correlation that you observe here will reduce the overall of the portfolio risk. Okay, or even better if it's negative. All right, so therefore we have done together some calculation yesterday. Okay, if yesterday someone asked me at the end of the class, if you have more than two stock, you can still form it, but I recommended to do it with programming and or at least in the Excel spreadsheet that allow you to make the metric of several covariants and so on and so forth. Okay, and yesterday we also learned about that in these investment opportunities, okay, a different way that you can perform your portfolio based on the proportion or the weight that you can allocate to one stock compared to another stock of your overall 100% of your weights. Okay, and then these possibility, okay, provide the different type of what we call the investment frontier, and these show that some allocation are efficient, some don't, right? Like the case that we have seen here, the blue one is the zone where the allocation of your investment based on different weights are not the efficient way to invest, because with the same volatility you can find a better return. So therefore the one that give you the lower return with the given volatility is inefficient. All right, so, and last but not least, we also learned how we combine the risk-free asset with the portfolio. Okay, so in this case, would allow you to adjust easily on the way you're gonna allocate your, the universe of your investment opportunity, and try to find out what is the level of return that you can maximize at the given level of volatility. Okay, So as you can see that because when you combine with the risk-free asset, you can have some kind of linear relationship between volatility and return as it's shown in the line. Okay. However, this line, okay, as you can see that you can still find if you look at the blue line, you can see that as a given level of volatility, at the point, you can still find some better in the red zone, isn't it? So therefore, the idea is you should move the line of the blue one, okay, to the one that will touch that frontier that you get the highest slope of that line, okay? And the slope of that line is known as a particular type of ratio, which is called the Sharpe ratio. The Sharpe ratio would allow you to, compare whether which one, whether the blue line or another line, which one is better off. The higher Sharpe ratio, the better that you should earn or you should get the risk return trade-off, right? So the one that has the best, we called it as the tangent portfolio. It's a theoretical portfolio, and that should have the highest Sharpe ratio, okay, which is the case where we can see here the blue go to the green, and the green line is called the tangent one, right, where is you can see the slope is the highest. Okay, so that is a kind of optimal portfolio choice that we learned yesterday. And when we end up by introducing you that, how can we get these tangent or efficient portfolio in the real world? This is a kind of theoretical portfolio that is difficult to measure, okay? And what we learned yesterday is that we can assume that the efficient portfolio as the market portfolio. Basically, we can choose the market portfolio, okay, which is, for example, S&P 500 as a proxy. You understand what is a proxy means? Okay, the proxy is the representative of the efficient portfolio. You assume that the market portfolio is an efficient portfolio. In that case, you're gonna be able to find out this kind of capital market lie, and they where the capital market lie will touch, okay, and this, and therefore it is the way that you can do it in real life, right, in the real life. Okay, so we have learned yesterday about how to help your brother-in-law. Your brother-in-law here in the McDonald's stock alone. What you can do is try to find the position that correspond to your brother-in-law, either on their volatility or their risk that he want to take, or the return he want to receive. As you can see here, McDonald is in this point with the same level of return. You can move to this point, and this point represent a lower risk, lower volatility than the McDonald's stock. So therefore, this one is more efficient than investing in McDonald's stock. So you could recommend your brother-in-law to buy S&P 500, okay, with 83% of his allocation, right? If he has, I don't know, I forgot, 10,000, meaning that 8,333, if I'm not wrong, should allocate it to S&P 500, and the rest will go to the risk-free rate. In that case, they're gonna stand on this, he gonna stand in this capital market line, and this capital market line you can see here, you can have the same return as McDonald, but you reduce significantly the level of volatility he will hold. Okay, in the similar fashion, you should be able to find out that if you want to keep the level of volatility of McDonald, how you're gonna find better investment by keeping the same level of volatility. Okay, since you have to go here beyond this point, so therefore you have to allocate 169% in the market portfolio. Okay, and this one meaning what? Meaning that you need to borrow the risk-free rate and invest it more in the S&P 500. That is how we interpret it. All right. So, and then obviously, as we can see here in the CAPM, everybody will go in this capital market line. And this capital market line will kind of bring us to something that we measure the level of risk. Okay. And the risk that we are on this market portfolio or the CML line, we will have only market risk. So therefore, we can measure it in the form of market risk in the form of the beta. So where the beta is equal to the covariance of the RI and RM. Okay, it's meaning that they measure the sensitivity of the return of the stock I in relative to the market. Okay, if the usually the beta is positive. Okay, either you have higher degree of market risk or lower degree of market risk. Okay, for example, if I ask you a question on what do you think about the beta of Tesla company as compared to Johnson and Johnson, or Procter and Gamble, or Coca-Cola? Let's take a Coca-Cola. Do you think that the beta of Coca-Cola and Tesla, everybody know Tesla? Which one should have a higher beta? Beta of Tesla should be bigger or smaller than the beta of Coca-Cola. Which one do you think that it should be better? What do you think that the Tesla should market risk, the level of market risk should be bigger or smaller than Coca-Cola? Obviously, the Tesla or the riskier firm should have a greater beta than Coca-Cola. So therefore, when the beta is bigger, it means that the required rate of returns of the investor will require the required rate of return of holding of Tesla stock should be higher than expected return or required rate of return that you investor will need when to hold the Coca-Cola stock. So the level of the expected return can be computed through this formula. And this formula we call the CAPM formula. This is absolutely very important formula that you should know by heart, right? Because the CAPM would allow you to estimate expected return of the stock I, and this expected return of the stock I, we often use it to compute something called the cost of equity capital. Okay, so which is the kind of the KE, okay, the cost of equity capital that we're gonna learn part of them today and probably the also tomorrow. Okay, so we can use the CAPM to estimate cost of equity capital because it is represent on the equity part, on the stock part, what is the required return required by the investor can be used as an estimate of cost of equity capital. Okay, and then we have cost of debt capital, and then we're gonna have the firm cost of capital that I can illustrate it later. Okay, so the cost of equity capital or required rate of return of holding a stock I should be equal to the RF. It means the risk-free rate plus the risk premium for security I. How we compute the risk premium? We say that the risk premium for the security I, for the stock I, should depend on the level of market risk, not the total risk, not the volatility, only the market risk that we can measure in the form of the beta. And once you know the beta, which quantify the amount or the magnitude of the market risk, you can just simply multiply by the market risk premium. Market risk premium is the expected return on the market portfolio minus the RF. When you have the minus of the RF, we call this the risk premium. And the risk premium, okay, on the market multiplied by the beta, you're gonna get the risk premium for that stock I. Sound good? So far, so good. So yesterday we stopped like that. Before I go to the exercise, so I just want to, help you to introduce you what we call the security market line. Remember, if you have the McDonald, okay, like the way you do the um, with the how we call your brother-in-law, okay, you can just cross these to the CML line and going up to the CML line. Okay, so if I replot, let now take don't take McDonald, we go to Exxon Mobil. Okay, Exxon Mobil, okay, in the oil industry, you can see here if Exxon Mobil is has a volatility of 16 or 17% here, where the expected return is about 5, 6, 7, about 8, okay, or no, about 7. And then you can see here, if I cross to the left, I gonna see to touch the market, capital market line at this point. Everybody see my pointer? Okay, so if I cross to this, meaning that I can simply eliminate part of my volatility from this point to the CML line. So therefore, from this point to this point, we can call it, this is a proportion of volatility that contain the idiosyncratic risk. Okay, so therefore, the only this one and this one is the way we should not be able to diversify the way, and this one should represent the market risk. The volatility from this point to this point should represent the market risk. From this point to this point should represent diversifiable risk. Okay, and the total should be the total risk of ExxonMobil. So far, so good. Everybody follows? Everybody follow? Quoc done fun. I come back to your answer later on. Okay. So if you look at this, let's draw it. You see, if this one you cannot find the relationship, okay, between volatility and total risk, okay, what we can do, or the return and the volatility. So if I transform the Exxon, okay, I cross it to the right hand side, I transform the beta, okay, the volatility, and I plot it with the beta. Interestingly, that the beta of Exxon, which is about 0.4 something, okay, correspond well with the expected return, because you can see here from this one to this one, okay, represent quantitatively represent this portion, but this one is a different scale, right? This is a volatility, this is a beta, but you can see that the beta of 0.4 something, okay, and we're gonna give the Exxon expected return to the same point. And then I transform all the stock, like this. It means McDonald. I cross to the CML line. I take the proportion of this to plot as the beta. Okay, so the more you go on the right, okay, it means that the beta should be higher, right? So, and you can see that interestingly, I can plot the line of the beta and the expected return of all individual stocks, okay, which is in the real life it is true, okay, at least in the US market. Okay, so all these are come from the real data of those. It seems like the security market lie from the CAPM allow us to use the beta to predict the expected return, which is the main assumption on the CAPM. Okay, so if I come back to and this line we call the security market line. Okay, therefore, according to the CAPM, your all stock and portfolio should lie on the SML line. Obviously, with the real data, they may diverge a little bit from this, SML line. Okay, that's why we get the alpha. Okay, and then most of the investor measure how you outperform based on the expected return when the fund manager manage and make an investment for you instead of buying the market portfolio by yourself without having anyone to pick up some stock for you. Suppose, so obviously the CM, we come back to later on the CAPM has several assumptions that we have identified here, which is probably not realistic because the investor can buy and sell all security at competitive market prices. They have also tax and transaction. So therefore, they may have some, divergence on your calculation of expected return because of assumptions of the CAPM may not hold in real life. Okay, but still, if we take the data on the CML, the data with at least in the US or in many advanced country, the CAPM still, quite consistent with the data. Okay, which is probably not perfect model that we're doing right now, but CAPM is still the most popular and the most well-known to compute the cost of equity capital. Obviously, they have some other model that they are proposing at the moment. For example, Pharma Friend three-factor model and momentum. They add some of size and so on inside the factor that I can comment later on. Let's go back to the concept of the CPM. Okay, so suppose the stock called Bankruptcy Auction Service, BAS, had a negative beta. Sound odd to you, no? It means like the negative beta is minus 0.3. How does this require return compared to the risk-free rate according to the CAPM? Does this result make sense? Obviously, the company is what? Bankruptcy auction service. What they do, what the business do, they have more business when the economy goes badly, isn't it? So therefore, the market because the expected return of the market is higher than the risk-free rate, imply that the expected return of BAS will be below the risk-free rate. So the investor who gonna hold this stock usually is, or not usually, they expect to receive lower than the risk-free rate, which is a 2.2. Okay, so these results seem odd. Why investor be willing to accept only 2.2% expected return on this stock when they can invest in the same investment and earn 4%? The answer is that a savvy the investor will not hold BAS alone, and this BAS stock is a great potential of using as the to diversify the risk for investor. Okay, so therefore this BAS stock should normally hold by the investor who hold other stock as well. These other security will tend to rise and fall in the market, but because BAS has a negative beta, its correlation with the market is negative. It is, which means that the BAS tend to perform well when the rest of the market is doing poorly. Therefore, by holding BAS stock, investor can reduce the overall market risk of her portfolio. So in a sense, it's implied that the BIS is a recession insurance for a portfolio. It's like you buy an insurance and you pay the insurance premium. Investor will pay for this insurance by accepting a lower return. All right. So if you have several stock in your portfolio, you have different beta, beta 1, beta 2, beta 3. You can make calculate the beta of the portfolio using the weighted average of your beta. For example, if suppose the stock of pharmaceutical Pfizer, everybody has the vaccine COVID-19 Pfizer. No, you have AstraZeneca, Sinovac. Have you have vaccine? You have vaccination? Oh, you guys, you have Astra. I have 2 doses of Pfizer. You have also Pfizer in Vietnam? Yes. I have the best one. Only the in France, if you are younger than 55, they give you only Pfizer. They have only Pfizer and AstraZeneca. They only give to the people older than 55 because it seems like the second the side effect is for the younger one for Astra is bigger for the younger one. So in France, when you are young, they give only Pfizer. So I have no choice to get only Pfizer. Okay, but at least you have AstraZeneca. I think is better than most of the Thai people. They got the Sinovac uh, from China, which is not very efficient. Seems to be. All right. Most of us has one dose. The young got AstraZeneca. The old got Moderna, Pfizer. We in fun is the opposite. But in the UK, all the young or old they get AstraZeneca. But in the EU, they recommend the the young to get Pfizer and the old people get AstraZeneca. But the Pfizer is the most used in France. All right, so let's come back. So you have Pfizer has a beta of 0.5. The beta of Home Depot is 1.25. You can see that the pharmaceutical company usually has lower beta. Lower beta means that the market risk is smaller. Okay, when the economy goes badly, okay, when you get sick, you're gonna get the medication anyway, right? Where the Home Depot, everybody know Home Depot, what business they do? You have Home Depot in Vietnam. Everybody know Home Depot, what business they do? In which sector they are running? Home Depot is a US stock. Home furniture we call retail, right? The home stock is 1.25. As you can see that it seems that the market risk of the retail company should be bigger than pharmaceutical company, right? So if the risk-free rate is 4%, expected return of the market portfolio is 10%. What is the expected return of equally weighted portfolio of Pfizer and Home Depot stock according to the CAPM? Okay, so you can have two ways to do so. Either you calculate based on the each expected return, and then you calculate the expected return of the portfolio based on the weight. Okay. Second, alternatively, second method, what you can do is you calculate the beta of your portfolio. You wait first, and then you apply CAPM later on. Okay. So meaning that, for example, if I calculate expected return of the Pfizer, I can have 4% plus 0.5 multiplied by 10% minus 4. Okay, 10% minus 4, which is market return, expected market return minus 4%, I get 7%. Okay, what is the market risk premium? How much is the market risk premium in this exercise? What is the market risk premium? What is the market risk premium? How much? What is the market risk premium? What is the market? Exactly. Thank you. The market risk premium is 6%. Okay. This one, be careful. Sometime in the exam or sometime I can tell like, okay, market risk premium is 6%. In that case, you don't need to minus 4%, right? Because market risk premium is already represent the ERM minus RF, which is, okay. Then you get 7% for Pfizer, and investors should expect higher return when they buy or hold the Home Depot stock, okay, because the beta is bigger, 1.25, so they require 11.5%. Therefore, your expected return of equally weighted portfolio P will goes to 9.25%, okay? So alternatively, I can compute the beta of the portfolio based on the weighted average of my beta. I get the beta of 0.875, and then I plug 0.875 in the CAPM formula. I can get 9.25%. So the result should be the same. All right, this is about the question, the slide and the contents of the chapter 11. Okay, let's go quickly to the problem set. Have you done it? Anyone? Okay, if it's not, I can go quickly from this solution together. Okay, you are considering how to invest part of your retirement saving. You have decided to put 200,000 into 3 stocks, 50% in Goldfinger and 25% in Moose Head, and the remainder is Venture Associate. If Goldfinger stock go up $30 per share, Moose Hayes stock drop to $60 per share. Venture stock price rise to $3. What is the new value of the portfolio? What return did the portfolio earn? It's very straightforward. You can calculate the number of share that you buy in the stock G, the stock M, and the stock V. So since you have 50%, okay, of $25 per share, so you get 4,000 shares of your first stock, which is the Goldfinger, where another 25% you put it in stock of Moose Hedge, which is $80. So you have 625. In the venture, you have 25,000. The new value will gonna be 232,500. Very straightforward, right? So if you calculate the return the portfolio did earn, okay, so the total value of the portfolio beginning of the period is 200,000. The value right now is 232,500. This means you earn 16.25%. What is the new portfolio weight of these? Each of your new, obviously, the stock that the price go up will improve or increase the portfolio weight, right? The 50% goes to 51.61%. Moosehead stock price goes down. So therefore, percentage in your new portfolio or the same portfolio, but the value the goes down from 20%, 25% to 16.13%, where the venture, the value go up to 23.26%. Question number 2 is just very straightforward. Any questions? So far, so good? Yes? Okay. Let's go quickly to the second one. I cannot upload this for you, okay? On Sunday. So suppose Intel stock has an expected return of 26%, volatility of 50%, while Coca-Cola has an expected return of 6%, volatility of 25%. If these two stocks were perfectly negatively correlated, so it means correlation is 1%. Calculate the portfolio weight that remove all risk. If there are no arbitrage opportunity, what the risk-free rate of interest in this economy? Okay, so let me start by asking you questions. So what you have to do is you first read and then you write. If you don't know how to write, you reread and then you write. If you still cannot write, you come to see me next year. It means that you're gonna fail in your exam. It's a joke. All right. So what we can write, Intel has an expected return of 26%. What is that? Intel expected return. So I means the expected return of the ERI equal to 26% and SDRI is equal to 50%. Okay. And then you have expected return of the RC, which is Coca-Cola, is equal to 6%, and SDRC is equal to 25%. Okay, and correlation between the RI and the RC is equal to -1. Everybody can write this or not? Okay, so you read and then you write. So what I can write is I write exactly what I read. So I first write that ERI equal to 20 what? 26%. What else I can write? I can write as well SDRI equal to 50%. I can also write ERC equal to 6%. I can also write the SDRC equal to 25%. And then I finish with writing that the correlation between RI and RC equal to -1. Obviously, the rest is just only your high school mathematics. You plug it in on the equation. Okay, what the equation you need to do? The equation is equation of two risky stocks together. You are interested to know what is the risk of your two portfolios. So you can take the formula from this. Okay, therefore, I can simply apply the two stock perfectly correlated. So therefore, I can have exactly make the left-hand side equal to 0. And then I try to solve the x1 and x2. In this case, the x1 will be exactly of 1/3 and the x2 will be 2/3. And then you should be able to get, this one I go kind of short way to get the zero, but you can do it because sometimes it's not necessary 1/3, 2/3 like this, because this one, the 25% and 25% is here. So therefore, we can do it quickly like this. And once you get um, the volatility of your portfolio where the risk of the portfolio is zero, right? Because you take this one as a zero. Okay, so if you want to know the expected return based on your X1 and X2 that you solve, you're gonna be able to get 12.67%, which is the portfolio of return. And since this portfolio return with zero risk, with no risk, we can assume that this portfolio is a portfolio of risk-free in the economy, which is 12.67%. Okay. Any question? All right. So you see that the most important one is you read the problem and you write. Write in terms of variable, and then you're going to choose some formula to plug it in. Okay. And then when you sit down during exam or in your work or in your personal life, you write it down, and then you think about what you need to solve. Okay, let's go try another one. Consider expected return, volatility, and correlation. It's very straightforward, the same thing. You have expected return of EDF stock, which is the electricity company in France. They call Electricity of France. And Bouygues Telecom is a telecom company. And then you have the correlation, and the correlation is the same as the minus one, almost the same as the question number 3. Okay, you can solve it like the way we have expected return for the first question. Second one, you solve this volatility. Okay, since you know that this one you're gonna get 9% of the portfolio when you form EDF with the Bouygues. Okay. And what else? Tuk, tuk, tuk. And you allocate half and half, right? Weighted, equal weighted. Okay, you can still have the volatility of the portfolio of 9%. Okay, and then the last one, if you want to achieve the risk-free investment, the same of the question number 3, right? You take the variance or the portfolio is equal to 0, and you solve this equation, you're gonna be able to get 80% in the first stock and in EDF, and 20% in Bouygues. It's gonna give you exactly of the portfolio volatility of 0. Question number 5. This is easy too. So suppose the market risk premium is 6.5%, risk-free rate is 5%. Calculate the cost of capital of investing in a project with the beta of 1.2. The cost of capital is mean required rate of return of a project, okay, or a company. This one is a project which has a beta of 1.2. Means like you can apply the CAPM model. Okay, how anyone can help me to write the information we read from this. Suppose the market risk premium is 6.5%. What should we write? Anyone can help me to write? ERM, very good. ERM, okay, which is minus RF because it is the market risk premium equal to 6.5%. Yeah. If what is the 5%? Somebody can help me to write. The 5% is the is F, right? F is 5%. That makes sense? Okay. May I ask you what is the ERM? What is the expected return on the market portfolio? What is the expected return of if the market risk premium is 6.5%, RF is 5%, what is the expected market return? What is the expected return of the market portfolio in this problem? How much is the ERM? Nothing to do with the problem. I haven't, it's not the question of the question. It's just my question. How much is the ERM? If the market risk premium is 6.5%, RF is 5%, therefore ERM is 11.5%. Thank you very much. Okay, so once you have the ERM minus RF, which is a market risk premium, is 6.5. The beta is 1.2. So you're going to be able to calculate the ERI. The ERI will going to be equal to the RF plus the beta multiplied by market risk premium, isn't it? Okay, which is the ERM minus RF. Okay, so in this case, I can have 5%, okay, plus the beta. The beta is 1.2 multiplied by 6.5%. That's it. Very simple and easy. Okay, so therefore, I can have the value of 12.80%. Okay, that has been already answered by one of your friends. Okay, interesting. Question number 6. Suppose that the coming year you expect Microsoft stock to have a volatility of 23%, a beta of 1.28. McDonald's stock to have a volatility of 37%, a beta of 0.99. It looks weird, no? It looks strange or not? Microsoft has lower volatility, but higher beta, where McDonald has, higher volatility, but lower beta. Is this possible? Is this possible? What does this imply? Everybody follow my question. Microsoft stocks has lower volatility, but has a higher beta, whereas McDonald has higher volatility, but lower beta. It is possible because the beta is a part of the market risk, and market risk is bigger when the total risk is smaller. Is this possible? What do you think? It's due to the correlation. Almost, not exactly. Microsoft has lower volatility, but higher beta. By the way, beta and volatility are different scale, right? Beta is a value and another is a percentage, right? So Do you think it is possible a company has a higher volatility but lower beta like McDonald's, and a company can have, it means what different market? Well, it's the same market. They are traded in the US market. Microsoft, okay, let me ask you this question. Let me ask you differently. Which stock has higher total risk? Which stock has a higher total risk? Microsoft? Yes or no? No. How you gonna measure the total risk? The total risk, we look at the total risk, we look at the volatility, right? The volatility, the standard deviation is a proxy of total risk. McDonald's stock has a higher total risk. The answer of question number A, where Microsoft has higher systematic risk. Why is higher? Because the beta is higher. The beta is a proxy of market risk, where volatility is a proxy of total risk. The only thing that is not mentioned here is about idiosyncratic risk, meaning that the stock of McDonald's seems to have higher or high idiosyncratic rate that's specific to McDonald's, that's specific to McDonald's shop, that is maybe not necessarily the market risk, where the Microsoft, it's very depend on the market risk. They have a high level of market risk, where the business of McDonald's, they may be based on the restaurant they are doing and so on, but the business itself that related to the market risk is small, because they are in the food business. No matter the market go badly or go well, people still go and eat um, Big Mac, okay, where people may not buy new computer when the market goes badly, so therefore they don't buy new computer. They may not upgrade the Windows. The Microsoft business may also affect more on or depend on the market situation or the economy. So therefore Microsoft should have a higher market risk than McDonald's, that is identified or showed it in the beta. Okay, where McDonald's contained seems to be like McDonald's has a very high idiosyncratic risk, high level of idiosyncratic risk. That's why this is possible. Okay. Okay, you guys, is this clear? I could try to explain in a very easy way for you guys. Is this clear? Perfect. So in that case, if the risk-free interest rate is 4%, is the RF is 4%, ERM is 10%, you can see I can just simply read and write at the same time. Please estimate the cost of capital for the project 1 with the same beta as McDonald's stock. What does this mean? It means like when you are going to, make a franchise of food business, for example, you want to do another burger restaurant, and that have maybe the same systematic risk as McDonald's. Since you don't know this project, but you know that the risk of your project may be the same as the risk of equivalent of the market risk of holding McDonald's stock. That is your assumption. Okay. In that, so If is that so, you're gonna be able to simply apply the CAPM formula and calculate the expected return on the project one, which has the market risk equal to the market risk of McDonald's stock. Okay, so if is that the case, your estimate cost of capital for your project will be 9.94%. All right. So the ER project number two, where the risk of the project number two has the same level of market risk of Microsoft stock. So therefore, the project two seems to be a higher risk, okay, which is required higher return to 11.68%. Project number two with the same beta as Microsoft as a higher cost of capital. Okay, so volatility cannot help you to predict the expected return. Only the beta can help you to predict the expected return or estimate cost of capital. You cannot use volatility to estimate your cost of capital, but you can use the systematic risk to estimate your cost of capital. Okay, the last one, but not least, suppose the risk-free rate is 5%. Market portfolio has an expected return of 13% with volatility of 18%. LVMH has 24 volatility and correlation with the market of 0.8. So, can you help me to write? Anyone can help me to write. I read now and you write. Anyone can write, okay? Let me read. Risk-free rate is 5%. Someone can help me to write? Risk-free rate is 5%. Suppose that you are in the exam. Risk-free rate is 5%. If it's 5%, thank you, Tung Kien Tan. Another, market portfolio has an expected return of 13%. ERM is 13%. Excellent. With a volatility of 18%. Volatility of 18%. What is that? SDRM is 18%. Perfect. LVMH. Everybody know LVMH? What they do? What the business they do? LVMH. I speak like a French, but it's a French company. What they do? What they sell? They are in which business? Perfect. The Louis Vuitton, LV, Louis Vuitton, but they don't have only one brand of Louis Vuitton. They have, you know, luxury stuff, even the beverage. They have the luxury wine. They have Hennessy, you know, those kind of beverage, luxury, expensive beverage. But the Louis Vuitton is one of the, you know, brand, but they have so many brands as well. Okay, so, oh, Louis Vuitton, always happy in Vietnam. Okay, Louis Vuitton. Okay, so always happy. Very good. Always happy for having it. Always sad when you have to pay to your credit card, right? Okay, hope you're always happy. Oops. Continue. LVMH has 24% volatility. Somebody can help me to write. LVMH 24%. How should we write? You see, during exam, if you can write like this, even you do calculation wrongly, you can get points. Okay. So can you give me what is that? Volatility of VMH is 24%. How we write it? Is the who Cuckoo. Anyone can help me to write? LVMH volatility is 24%. LVMH. No one can write? You always happy? It is the SDRL or RI is 24%. What the question asks? The question asks the correlation with the market is 0.8. Correlation of the RI and RM is 0.8. Kwok Dong Fan, you are excellent. Now, the question is, what is LVMH's beta with the market? Okay, so when we call the beta with the market, because in later on when you learn more advanced courses, you can measure different way of the beta. Sometimes you can have beta 1, beta 2, beta 3, like that. So the beta is a covariance of the RI and RM divided by the variance of the RM, or the correlation of RI RM multiplied by SDRI SDRM divided by variance of the RM. I just plug some those numbers. You just help me writing it. So therefore, I get the beta of 1.067, which is the beta of LVMH. Okay, seem like luxury stock has a higher than the food stock or pharmaceutical stock. That makes sense, isn't it? Assume CAPM holds. What is the LVMH equity cost of capital? What is the required rate of return to investor who are going to hold the LVMH stock? So you can take the CAPM model. You have 5% plus 1.067 multiplied by 13% minus 5%, which is give you 13.54%. This is the 13.54% that it should be the required rate of return that investor may expect. Assume that the beginning of the year, LVMH stock price was 90 euro. If there was no dividend paid during this year, the stock price at the end of the year was 110. Did LVMH manager exceed their investor required return as given by CAPM? Obviously, the realized return of these stocks go to 22.22%, where investor require only 13.54% with the level of market risk they take. So therefore, the manager did a good job, exceeds the investor required return, okay, bond on this. And most of the manager or the CEO who can manage this, normally they also get compensation of making a return of the stock higher than the investor may expect. Why? How those CEO earn or got the money when they make a big return like this? Okay, because most of the CEO, the top CEO, they has something called the stock options. Okay, if your exercise price that you got it from the company is lower, the more you enhance the return of the stock, the higher value that go back to the manager who hold those stock options. Everybody know what stock options? Do you know what is the stock options? Anyone has a stock option? Your bank give you an stock option? Somebody know what is stock option? The option to buy company stocks. Okay, so it's the right to buy a stock at a given price. Okay, the right to buy a stock at a given price, which is called a call option. You can have also put option and so on. Okay, if you study derivatives classes, you should be able to learn more about it. Okay, these are part of derivatives we call option. And in corporate finance, manager also gain or earn not just only the base salary, they earn also bonus, they also earn the stock option. And stock options in the advanced market become very big part of compensation that the executive or the manager get from their work. Okay, so therefore these stock option, we need to know how to price those value, do valuation of option as well. All right, I'm finished the chapter 11. Okay, I think after repeating what we have yesterday, it seems a bit fast for some of you, I can imagine, but I think after today revision together with exercise, I hope that everybody should somehow follow the main concept that we learned in chapter 11. Okay. Oops. Why I put this here? Okay. Do you have any questions? See, it's always worthwhile to come to my class to learn, because even you could not follow yesterday, after I repeat, after I make some exercise, after I guide you, I think it make your life much easier, so that you can understand. Okay, try to understand, not memorize. You know that when you memorize things and then after exam you forget everything. Okay, that's why I always give you some trick of recalling some of those concepts, because maybe you cannot easily recall those concepts, but you may recall my joke, you may recall the way I explained to you. So therefore you can check some of the point from books, from textbook later on. Okay, you don't need to memorize everything, so we don't need to, but you need to understand. Okay. Perfect. Thank you so much. So we're gonna go right now to the new module on the estimating cost of capital in the chapter 12. Oh, it's already 3:30. So why don't we make a short break of 15 minutes, and then we come back to the new chapter, which is how we estimate cost of capital for a company. So we look at the weighted average cost of capital. Somebody have already learned and know about this, or the WACC. What is the firm cost of debt? What is the firm equity cost of capital? We look at the weighted average cost of capital again, how we're going to use the WACC to value a project, and so on. That is the contents of the chapter 12 that we're going to see it together after the break. Let's have a break first. All right. See you in 15 minutes. I can have my lunch and then I come back. All right. You still need to see Eiffel Tower. Ah, you see better today. Oops. Small Eiffel Tower. You saw it, right? See you. Okay. All right. So it's now recording. All right. So if you look at the corporate balance sheet, right? What is a balance sheet? The right hand side, the left hand side represent assets. Asset represent the what the company owns. They own the asset that you can transform into cash quickly. Okay, quickly in accounting and finance mean less than 1 year. We call the current assets. When is more than 1 year, we call long-term assets. And these long-term assets are fixed assets. Okay, some are tangible, some are not tangible. We call intangible assets. Okay, and all these are the assets that the company own to generate cash flows. On the right hand side, that we call liability and equity. The right hand side, you can also do two things. One is borrow from someone. You issue debt, you get bank loans, you issue bonds, or you invite investor to participate in the equity part, in the ownership part. Okay, either in general issue common shares. Okay, we call equity. Also, you have a particular type of equity which is called preference shares or preferred stock. Okay, what is the difference between preference shares and common shares, or the preferred stock and common stock? What is the difference? Somebody know what is a preferred stock, right? So they have two characteristics that make difference between preferred stock and common stocks. Okay. In a common stock, when you buy a stock, you become a stockholder. You expect to get dividend and you expect to get the capital gain. You not only get these we call cash flow right, we have also the voting right. But when you uh, buy a preferred stock, you become a preferred stockholder. You expect to get first, we call fixed dividend. Okay, in general, for common stock, you are waiting until the company earnings, and then company may make the payout, distribute their profit to the shareholders. Whereas the preferred stockholder, usually they tell you in advance how much they're gonna pay dividend, which is fixed. Okay, they give it to the preferred stockholder in advance. It's almost like coupons, but it's not coupons. Okay, because coupon is a debt you borrow and you pay, interest in some sense, but we don't call interest, we call coupons, where the dividend usually you don't fix, and preferred stock is something between. Okay, it's a hybrid. So second, in the preferred stock, you have also something that is uh, different from the common stocks, is that you have no voting rights. Okay, you have no voting rights. Okay, the voting right goes only to common shareholder, not the preferred stockholders. All right, so what do you prefer then? You prefer preferred stock or you prefer common stocks? If you don't know, you say it. If you don't know the answer, you say it. It depends. It depends that it's like you going to buy bond or you buy stock issued by the company. It depends. You want to be a debt holder or you want to be a stockholder. The risk is not the same. The return is also not the same. Okay. So where the preferred stock is between the debt or bond and the stock. Okay, so usually in case of, for example, company in distress or bankruptcy, the cash flow rights, okay, we call the cash flow waterfall, go to the debt holder first, and then they pay to the preferred stock, and what remaining, they go to the common stock. So preferred stock has priority on the cash flows. before the common stocks, but after debt holders. Okay, something is between. And therefore, a lot of startup company, they may have limited capacity to pay debt. The debt capacity is not big enough. Often they issue the preferred stocks to the investor in some round of startup fundraising. Okay, so that is what we call the balance sheet. Interestingly, company may shoot the structure on the right hand side differently. And the structure on the right hand side, the proportion that the company borrow from someone by having debt, and some company have more debt, some company has less debt, and this one we call the company's capital structure. Okay, for example, Apple has almost no debt. They finance everything by cash. Okay, because it's a very cash rich company, they don't have a lot of debt. Where the Southwest Airline, they have proportion of debt. Okay, this is the example of the firm capital structure. So if you look at the uh, average cost of capital of a firm, it means like you can calculate weighted average on your right hand side. Okay, you can take the percentage of debt multiplied by the cost of debt, percentage of preferred stock multiplied by the cost of preferred stock, percentage of equity multiplied by the cost of equity capital. You're gonna get the weighted average overall cost of capital. Okay, so in that case, we're gonna call it as weighted average cost of capital, which is WACC. Should be blend of the cost of different sources of capital that the corporation, use to those funding, those source of capital to finance the asset of the left hand side. Okay, so when we're talking about here, okay, we're talking about that when you learn in financial statement analysis of what we call the book value that you can see on the balance sheet on the financial reports. But in finance, we look at more on the market value of balance sheet. So everything is based on the market value of assets, market value of debt, and market value of preferred stock, and market value of equity. This balance sheet is a market value balance sheet in finance. Okay, so market value of balance sheet, which is market value of the asset of the left hand side, should be equal to the market value of debt plus the market value of equity. All right, so if I have a fraction of firm value financed by equity, it means E over D plus E multiplied by the RE plus D over D plus E multiplied by the RD. Can you just have a look? Nothing complicated. It's just only the way we do weighted average. Okay. When you have weighted average based on different weight on equity multiplied by cost of equity, uh, weight on D multiplied by the RD, you're going to be able to get the RWAC, which is weighted average cost of capital, to estimate the firm cost of capital. Okay. If the firm cost of capital or in the company with debt, we call it levered firm. Okay, levered firm is mean firm with debt. Like Apple, if they have no debt, we call unlevered firms. Therefore, if unlevered firm, the D becomes zero. Cost of the RWAC of unlevered firm should be equal to the equity cost of capital. Okay, nothing complicated. Suppose the K9 Corporation has debt with the book value of 10 million, trading at 95% of face value. It also has book equity of 10 million and 1 million share and common stock traded at $30 per share. What way should K9 use in calculated is its WACC or the WACC. Okay, it's very straightforward. You need to do everything based on market value. Okay, what is the market value of debt? Okay, So the market value of debt, since the debt has the, $10 million of debt trading at 95% of that face value, it means the market values goes down to 9.5 million US dollar. Whereas the share of the stock, okay, is traded at $30 per share. So therefore, the 30 billion is the market value of equity of this company. So therefore, the company has the market value of firm of 39.5 million. Okay, 39.5 million with 9.5 debt. So therefore, the proportion of the debt over asset, which is debt plus equity, would be 24.1%, and 75.9% is equity. Okay, just check your you have to study the financial statement analysis, isn't it? Okay, may I ask you some question on this question? What is the market to book ratio on this? And what else you know? What is the gearing ratio of this company? Somebody know what is the gearing ratio? Or what is the leverage if I measure by debt over total asset, D plus E? What is the leverage ratio? May I check? May I check your financial statement? Do you know market to book ratio? Do you know gearing ratio? Do you know leverage ratio? If I take debt over E plus E, or I can measure leverage in different ways. So let's assume that I gonna measure by debt over capital, or D plus E. What is the market to book ratio in this company? Do you know what is the market to book? If you invest in stock market, the capital market, they often refer to this market to book ratio. So let's take the market to book ratio of equity. Somebody know how to get the market to book ratio of equity? So we're gonna be market value of equity divided by the book value of equity, isn't it? What is the market value of equity for this company? What is the market value of this company? Market value is, no, it's not 3. What is the market value? It's 30 million. Thank you. And 10 is the book value, okay? What you see on the balance sheet, okay? So the book value of 10 over 3, so it becomes 3. Perfect. What is the gearing ratio? Have you heard something about gearing ratio? Gearing ratio is way to get the capital structure, to explain the capital structure on the right hand side. Okay, you can measure several ways. So you can use debt over total asset, debt over debt plus equity, we call the debt over capital, or you can put debt over E, which is equal to the what we call the gearing ratio. Okay, so what is the gearing ratio of this company? What is the gearing ratio of this company? So you may ask, should I use the book ratio or market value? book or market. Okay, you can calculate both. If you make the financial statement analysis, you can use a book value, but if you use market valuation, you should use market value. Okay, let's do both. The gearing ratio for the book you have 10 over what? Over 10, which is 1, which is not really representative. And then if you take the book to market value, you're going to have debt, which is 95 divided by 9.5 divided by 30, which is 0.3167. Okay. Mm, So if you use the gearing ratio, everything based on book value, you're gonna have 10 over 10. If I use the market value of debt divided market value of equity, market value of debt was gonna be 9.5 divided by 30. Okay. What is the leverage ratio? So the leverage you can use what? If I use market leverage ratio, or you can use book leverage ratio. Let's take the market leverage ratio. I can have what? What the debt? Dot with debt is gonna be 9.5 divided by exactly. You have to divide it by D plus E, and D plus E should be what? D plus E should be 39.5, right? Okay, which is now is a leverage ratio. Okay, D over E, we have another name we call gearing ratio. D over E, which is the one type of leverage ratio. Leverage ratio is a kind of large term. You can define it more precisely with the D plus E. You can use D plus D plus E. You can divide it D divided by asset. Okay, all these are leverage ratios. Okay, where the D over E, we have a specific name, which is called gearing ratio. I will not go for that detail, but okay, don't worry too much. If you find a book, they give you different definition. It really depend on how you define it. Okay, it's like when you calculate the ROA, return on assets. Sometimes people use net income over total assets. Some people use EBIT over total assets. Some people use EBITDA over total assets. You can use, it depends on how you interpret those ratio. All right, is this clear? Is it okay? The idea is we want to see the right hand side, which is called the capital structure. Okay, in finance, what I'm going to do in my class, everything based on market value. In finance, we do care less about book value. We are interested about market values. Everything is based on market value, not accounting based book value. Okay, because finance, we are interested in looking forward measure. Market value is a looking forward measure, where accounting based book value are backward looking value, right? You look at end of the day or end of the year, what's going on from the beginning of the year until the end of the year is a backward, right? All those accounting book value are backward looking value. Okay, when you do the market value, that we do a lot in finance, when you do valuation, when you do all those in finance, we use market value. Why market value? Because we are working on forward looking value. These two perspective, I don't say which one is better. Okay, just only two different ways to look at it, about that one. The market value can be different from the book value because market value represents the forward looking value, where accounting book value represent backward looking value. All right, so now if I know how to calculate, okay, the idea is I want to know d over d plus e, e over d plus e. So I know that all these fraction, okay, I use the market value. What I have to know now is to know RD and RE, how we estimate RD, how we estimate RE. Okay, so again, the RD here is not represent the interest rate that company or the bank loan you have, that is the book cost of debt, but we are interested about market firm cost of debt. Okay, a firm cost of debt is the interest rate it would have to pay to refinance its existing debt, such as through new bond issues. Okay, these rates differ from the coupon rate on the firm existing debt or the interest rate on your bank loans that you had already. Okay, because which reflect the interest rate the firm had to offer at the time of the debt swap issue. It does not represent what the rate you have to pay to investor to issue the bond today. Okay, so the firm cost of debt should represent this. So therefore, the cost of debt depends on the yield to maturity, the yield that investor demand to hold the firm debt, new or existing. Okay, so the yield to maturity, everybody know what is the yield to maturity, right? So the yield to maturity of the debt is the yield that investor demand to hold the firm debt. Okay, if you want to calculate exactly the effective cost of debt, since interest rate on the debt payment or the interest rate payment on your debt is tax deductible, so therefore the effective cost of debt would be RD multiplied by 1 minus tax rate. Tax rate is a corporate tax rate. Okay, so by using the yield to maturity on DuPont's debt, we found that the pre-tax cost of debt is 3.66%. If DuPont's tax rate is 35%, what is the effective cost of debt? Obviously, the effective cost of debt we're gonna be 3.66% multiplied by 1 minus 0.35, which is bringing the DuPont effective cost of debt equal to 2.379%. Okay, so that is how we do it. All right, so I don't need to explain the tax deductible, right? Many of you working in the bank, so you know that the interest payment that you pay to your bank can be used to reduce when you calculate the tax rate, the corporate tax rate. Okay, now what is the debt yield? The debt yield is a yield to maturity, is the IRR investor will earn from holding the bond to maturity and receive its promised payments. If there is little risk, the firm will default. It means the yield to maturity is a reasonable estimate of investor expected rate of return. Remember when you calculate the yield from the bond valuation in your investment class, okay? You take all the coupons with the principal or face value at the maturity, and you calculate the R that make the NPD, the value of the bond, equal to the price of the bond, and the R that make this one we call the IRR. This IRR we call yield to maturity. Okay, so if you remember well, the yield to maturity, you have to take all the cash flow that bond holders may expect to get all those promised payment from the debt issuer or the bond issuer. So therefore, if there is a little risk of default, the firm is less likely to default. So therefore, the yield to maturity can be used as a proxy as the estimate of investor expected rate of return. Okay, so basically what that is mean is we can use the yield to maturity as the cost of debt. However, if the likelihood that the bond may default, it means like the yield that adjusts and used in the promised payments of all the bond until maturity, the yield to maturity will overestimate investor expected return. So we cannot use the yield to maturity with higher risk bond as the cost of debt of the company because it will overestimate the cost of debt. Do you follow me? Do you guys follow? If you don't, I give you example. Let's assume that I have a 1-year bond with the YTM, which is the yield to maturity of Y. For each $1 invested in the bond today, the issuer promises to pay 1 plus Y in 1 year. Everybody follows? In 1 year, you're gonna get $1 back plus the yield, the return on that, or that of the bond. Suppose the bond will default with a probability of P, in which case, a bondholder receive only 1 plus Y minus L. What is the big L? The L is the expected loss per $1 of debt in the event of default. Meaning what? Meaning that if the company goes bankrupt, your outstanding debt of $1, you may get back less than $1. You may have some expected loss from your debt in case of default of the bond. So therefore, the total net that go back to you will be 1 plus Y minus L. Okay? Minus the loss, the expected loss per dollar of debt in the event of default. If I calculate expected return where I have two possibility, one is not default, another one is default. So if I put the probability inside in case of default, I'm gonna get P multiplied by U minus L, right? The loss rate of and U minus L. So I get multiplied by the P, that will gonna be the probability of default, P. Probability of default, P, okay? In case of default, in case it's not default, you're gonna get the yield. In case of not default, you're gonna get 1 minus P. So therefore, the total expected return of the bond of the debt, RD, we're gonna be equal to 1 minus P multiplied by Y plus P multiplied by Y minus L. If I derive these equation, I'm gonna get that the RD should be equal to the Y minus PL, which is the yield to maturity minus probability of default multiplied by expected loss rate. The importance of this adjustment depends on the riskiness of the bond. Everybody follows. Everybody understand what this equation, where the equation come from, right? I have two probability. One, the bond is default. The one is the bond is not default. If the bond default, I get the Y minus L. I have multiplied by P. If the bond is not default, I gonna get the yield complete multiplied by 1 minus P, and then I solve this equation, I get Y minus PL. So you can see that the RD should be equal to Y minus PL. This is the formula to estimate cost of debt capital or debt cost of capital. And you can see that if the probability is close to 0, For example, the AAA bond, the bond that is less likely to default, you can use the Y to estimate cost of debt. Okay, as I explained you here. Okay, right? So the yield to maturity can estimate if the little risk of the firm default. If it's the risk of the default of the bond is high, you have to adjust with minus PL like this. Okay, give example. This is an annual default rate by debt rating. If you have several rating, triple A, double A, triple B, like that, the average default rate in the normal economy would be 0.0%. It's not 0, but it's 0.000 something. And the probability of default for the triple C bond is 9.9%. Okay, that is come from Moody's. You know what the Moody's, right? The Moody's is a rating agency. In case of recessions, okay, like the pandemic or economic recessions, the triple A bonds is still 0.00 something, and the double B, triple B goes to 3%, double B goes to 8%, triple C bond go to 43%. Everybody know the bond rating, isn't it? Everybody know bond rating? Yes. Okay. So the best, the highest rating with lowest probability default, we call triple A, right? And if I have the grade of the bond lower than triple A, which one we gonna get? That is the S&P. If I have Moody's, they're gonna write like this with the triple A. Okay. If I have, let's take the S&P, the triple A and triple A lower than triple A, we're gonna be triple A minus, and then you get double A plus, and then you get double A, you get double A minus, you have what? A plus, blah, blah, blah. Okay, until you go something called triple A, triple B minus, which is a kind of, line, which is called investment grade line. And the bond that got the rating beyond this rating, triple B minus, we call investment grade bonds. And lower than the triple B minus, we call it as the, anyone know? Bond with lower investment grade. How we call that one? Anyone know? The bond that is lower than investment grade rating. How we call that one? What the name of the bond who got lower than triple B minus? We call, in the old days we call junk bond, but junk has kind of negative implication. So people these days called it as the what? They call high yield bond. Look better? High yield bond just mean that the bond that generate higher return, so which is equivalent to the junk bonds. Okay, but these days they call the high yield bonds. It's like the World Bank in the past, they call the economy in this world as the develop developing economy, and then they call underdeveloped, and now they stop underdeveloped because politically you call economy or the country underdeveloped is look negative. Now the they the World Banks or most of the report they called it as only, you know, developed and developing economy. Okay, so since the developing economy become very large, you have well-developing country and very small and really less developing countries. So therefore, in the high and medium income developing country often refer to emerging economy. Okay, so which is a kind of rough definition to avoid or to distinguish, you know, the among developing countries, they are quite high and medium and emerging and growth, high growth economy. Okay, so how we call the Vietnamese economy? We call emerging economy. Yes, we call Vietnamese economy as an emerging economy. We can also have another, you know, uh, Vietnamese is part of the, um, we call the transition economy. Do you know what is a transition economy means? Anyone knows? Thailand is not transition economy. Vietnamese is a transition economy. Which country is the biggest transition economy in the world? US? No, US is not the transition. China is a transition economy. What is a transition economy means? Exactly. So we call the planned economy that transform to market economy. Okay. And this one is referred to transition economy. Okay, where in the past the government or communism or the government plan everything in the economy, and then they transform little to the market economy, but the government still control significantly on the action of the economy, actor in the economy like China, Vietnam, Russia, or some of those European, Eastern European countries. They all these are called the transition economies. Okay, let's go back to our business. So as you can see here, I can see the different type of the probability of default based on the historical data that allow you to plug the P, okay, and then also the, you know, expected loss rate on the unsecured debt is about 60%. It means $1 of outstanding debt, if you have clean loan, it means you don't have any collateral. We call unsecured debt. Okay, this unsecured debt, in case of bankruptcy, your $1 should go down to, you know, 40 cents, because the expected loss rate would be 60% of the value. Okay, so therefore, for example, if the expected return of B rating bondholder, if the, you know, default rate is 5.2% with the expected is 60%. So therefore, the expected return of B rating would be 3.1% below the bond quoted yield. Okay. So alternatively, this is a way you can calculate yield to maturity based on this formula. What we can do also, we can borrow the CAPM, which is normally the CAPM is a formula to estimate the equity cost of capital, right? Because it's derived from the stock, not the bond. However, if you are able to quantify the market risk of debt, which is relatively low, the debt beta might be able, you can borrow the CAPM formula to estimate the cost of debt based on the debt beta. Okay, so as you can see, you can imagine that usually the debt beta is relatively low, okay, compared to the equity beta. And the debt beta, as you can see that from A and above, the average is 0.05, triple B is 0.1, and so on and so forth. This is based on rating. You can also have some kind of by maturity of the triple B and above. They don't have the maturity of, junk bond or high yield bond. If the 1 to 5 year, the beta is about 0.01, go to 0.17 for maturity bigger than 15 years. Very difficult to get a very precise data on that. All right, so example, in mid 2009, home builder KB Home had outstanding of 6-year bond with the yield to maturity of 8.5% and the double B rating. If corresponding risk-free rate were 3%, market risk premium is 5%, estimate the expected return of KB Home's debt. Okay, so what you have to do, you first read and then you write. You don't know how to write, you reread and then you write. Okay, so bond 6-year yield to maturity of 8.5%. What is 8.5%? Somebody can help me to write. We need this formula, right? We need Y, we need P, we need L. And then we need also number based on the beta and the equation for the CAPM. Okay, what is the yield to maturity 8.5? What is that? It is perfect. Thank you. The yield to maturity or Y. Okay, let's take the Y. Y equal to 8.5%. Since the bond is a double B rating, so what we need to do is go back to this double B rating. What is the probability of default if we use the default rates from historical data? In 2009, can we consider as what? As a recession period, right? So this 2009 after the global crisis, so they're still in the recession period. So the P, the probability of default would be 8% here, right? In the normal time, you can apply 2.1%. Okay, so if corresponding risk-free rate is the RF equals 3%, market risk premium is mean ERM minus RF is 5%. How to estimate RD of this company? If I use the first method, I can have the RD equal to Y minus PL. Y is 8.5%. P is 60. P is 8%, the probability of default. Assume that this debt is unsecured debt. Unsecured debt, the loss rate is 60%. Okay, and then I gonna have the RD equal to approximately 3.7%. If I look at using the CAPM, I gonna go for this one. I have double B rating. Okay, with the maturity of 6 year, what information I can get? Okay, because it's a double B rating. Is it double B? Yes, it's a double B. So the double B, I cannot use the maturity because the maturity, it should be triple B and above. So I have only this information, which is 0.17, which is the beta of double B bonds. Let's assume that this is the beta of double B bond. I can have the RD equal to the RF. I apply CAPM plus I borrow. Again, CAPM is the equity equation, is not the debt, but we can borrow as long as we are able to estimate the beta of the debt. Okay, I have 3% plus the 30.17 multiplied by the market risk premium, which is 5%. Okay, which is the market expected return of 8 minus 3 equal to 5. So in that case, I can get 3.85. You can see both estimate are rough approximation. They both confirm that the expected return of debt is well below the promised yield of 8.5%. You cannot apply 8.5% as the cost of debt for the company who has, low or high risk bond. Okay, so far so good. Everybody follows. Yes? Perfect. Let's continue. So if I have preferred stock, you remember when we have a preferred stock, when you buy preferred stock, you become a preferred stockholders. So you're gonna get dividend. That assume that you're gonna get dividend forever. And since the dividend is fixed, okay, so the price of the preferred stock, okay, should be equal to the dividend divided by R. Therefore, the R will gonna be equal to the dividend divided by P. Everybody follows? So you have perpetuity formula. So the price of the preferred stock should be equal to all dividend, and you discount it, right? So if it's dividend 1 equal to the dividend 2 equal to the dividend 3 over forever, you're gonna get the price is equal to the dividend divided by R, right? And then if I want to know what is the R, I can simply take the dividend divided by P. And this one we're gonna be the cost of preferred stock. Cost of preferred stock we're gonna be equal to the dividend divided by the P, which is called the dividend yield. Okay, assume DuPont Class A preferred stock has a price of $66.67. Annual dividend is 3.5. The cost of preferred stock, very straightforward, would be equal to 5.25%. That look okay if it's the same data. So the cost of debt is lower than the cost of preferred stock. But if you want to calculate the firm cost of equity, obviously, if you know cost of equity of the company, you should be able to calculate the cost of equity capital using the CAPM. So if you know the beta, you know the risk-free rate, you know the market risk premium, you can just simply apply the CAPM. You're going to be able to calculate the cost of equity capital, right? Assume that equity beta of DuPont is 1.37. The yield on the 10-year treasury notes, we use the long-term debt as the risk-free rate of 3% and estimate the market risk premium of 6%. DuPont cost of equity capital will be 11.22%, which also makes sense because it should be higher than the preferred stock and also higher than debt. Okay, that is the first you can estimate using the CAPM. The second approach that you can do is, remember, we have Gordon-Chaprio model. I can use the, 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 the formula of the P0 equal to the dividend divided by R minus G, right? So if you have the, perpetuity of the with the constant growth rate, okay, which is we call the Gordon-Chapiro model. So we're gonna have the dividend 1 divided by R minus G. Okay, I can rearrange this one to get the R. I gonna get the R, we're gonna be equal to the dividend 1 divided by the P plus G. Okay, G represent the dividend growth rate. For example, if the average forecast of DuPont long run earning growth rate was 6.2% with expected dividend in 1 year is 1.64, a price of 36.99. So I'm gonna be able, using the DuPont cost of equity in this method, I get 10.6%. In the CAPM, I get 11.22%. So the value is about 10.6 and 11.22. In the estimating, I come back to you later on to your question. The estimating cost of equity, okay, based on the CAPM and constant dividend growth model, has some pro and some cons, some major assumption, and so on and so forth, which is represented in this slide. Okay, let me go back to this. In gearing ratio, how do we actually determine the market value? Okay, Tudo. Okay, the market value in the gearing ratio. Okay, since we have, if I come back to this one, you can see that the value of book value of debt is 10 million. Okay, so you can use the gearing ratio based on the book value. In that case, you can use 10 million. But if you want to know the market value, since bond has been traded at 95% of the face value, it means if the value, the face value is $1,000 that is indicated on the bond, the value you can sell and buy today, you can trade, is only 950. So therefore, the market value of debt is 95 here. Okay. Same for the market value of equity. You can use the 1 million share. The stock is traded at $30 per share. So therefore, the market value of equity would be 30 million. Is this clear to you? For the gearing ratio. Okay. So as I told you, if in your financial statement class, okay, the gearing ratio, you can use the debt over equity based on your book value. Okay, so in my finance course, I can calculate the gearing ratio based on market value. Okay, I have two ways to calculate it, right? Because I'm not interested about historical data of the capital structure value, but I'm interested about forward-looking value of the gearing ratio of the capital structure of a company based on the market value, right? Okay. So tomorrow we're gonna continue to make some calculation on the different methods, different way, and then we're gonna be able to find out the way we're gonna, solve and estimate cost of capital, which is very important when we do valuation of firms and valuation of equity and so on. So let's continue next. Before we leave, can I just have a look quickly on the problem set? What you can do? Okay, you can do question number 8. Very easy. Why don't you do the question number 8 and number 9? I can explain later on, but question number 8 only one probably. Question number 8 as a homework. It's okay. Perfect. So I'm gonna finish the class today, okay? And I will see you tomorrow for 9 o'clock in Paris time and 2 o'clock in Vietnamese time on Saturday and Sunday. My question, sir. Okay, you have a question? Example 12.3, can I use beta by maturity which is 0.06. In this table, you cannot use it because the bond is rating at double B, where the beta in that table, that particular table, is only applied to triple B and above. Do you see that? The sub, I can show you. Oops, where is that? This one. You cannot apply 0.06, okay, because this is the maturity that I have is only based on triple B bond and above. Double B bond is below triple B. So by maturity, this table cannot apply for our exercise. Yes? Okay. So thank you again for today and look forward to meeting you tomorrow. Have a good night. Have a good dream. Have a good dinner if you haven't had it. And look forward to meeting you tomorrow. All right. Thank you very much. And enjoy your evening and see you tomorrow. Bye bye.